A lot of new investors have not seen volatility. There is uncertainty, but one doesn't know if it is going to be all bad or all good.
Uncertainty is creeping from obviously US, and luckily for India, the trade tariff, clearly we've seen that India is not trying to retaliate, it's trying to negotiate a way out.
Quality in this uncertain time is a safer bet. I mean, there's nothing called safe in equity, but still a safer bet.
But for us as fund managers, the responsibility is to identify what that moat is, how durable that moat is. I think Warren Buffett has used this term quite frequently. The first filter is, I think, a kind of non-negotiable. Like it has to be a high ROE company, and then we can work around the first filter you would adopt while picking stocks would define what factor style you are trying to bias the fund with.
What has performed will continue to perform is a fallacy that most investors fall for.
So nowadays, a lot of strategists or economists are talking about dollar devaluation or depreciation. We believe is that when times are uncertain, people tend to appreciate companies which can generate earnings or cash flow on a consistent basis.
At such a time, investing into something which is less cyclical, probably a better quality, and a more long-term bet is probably just the right time. Hello everyone. In today's episode of our podcast, we have with us Mr. Ihab Dalwai, Fund Manager with ICICI AMC. Very interesting times for us. Yeah, lot of uncertainty happening in market. We don't know where things are going. You've been with ICICI since 2011, and before that also you were been on the research side, and we've been in market for over 15 years. 15 years. What do you think is happening?
Yeah, rightly said. Currently there is a bit of uncertainty. And that uncertainty is creeping from obviously US from its trade tariff aspect, and recently the geopolitical issue back home as well. But I think we have to see in context to what impact it can have on earnings. And luckily for India, especially the trade tariffs thing, clearly we've seen that India is not trying to retaliate, it's trying to negotiate a way out. And in spite of that, the impact on companies, like we have fewer sectors which can get impacted because of the trade tariffs. Few of them would be a bit of auto components, a bit of pharma if tariffs are specifically implemented on that space. But I think we have our IT sector. In case because of the tariffs US goes into a slowdown, it can to some extent impact our IT. But if you look at the broader market, I think we are less impacted versus other trading partners of US. But till there is clarity on the trade side, I think that uncertainty would prevail and continue. And to some extent, I think it's causing a bit of top-down or macro uncertainty in US. So nowadays, a lot of strategists or economists are talking about a concept of dollar devaluation or depreciation, which can lead to a lot of other currencies doing better, maybe few commodities doing better, resulting in a bit of capital shift outside US to different parts of the world or different asset classes. So that is happening. And because of which we're seeing this sporadic rally in certain commodities or precious commodities like gold as well. We've started seeing inflows, FI inflows back into India as well. So there's a lot of, I would say, shift happening, global capital shift happening currently because of the uncertainty or changes which are happening because of the trade tariffs which have been implemented or are going to be implemented in the near future. Yeah.
Very rightly said. And I think there is uncertainty, but one doesn't know if it is going to be all bad or all good. There is something which would be a downside risk and something which would be an upside risk. What do you think would some of those be? Like what could take market maybe towards an upswing here, or what can be something that will make market go slow?
Yeah, so clearly what we have seen in India from an earnings perspective, especially over the last, I would say 3-4 quarters, earnings have slowed down. So post-COVID till FY24, we had a very strong earnings growth. Because I would say base was lower, corporate profit to GDP was lower, and you're seeing an upswing in that ratio. So we've reached around 5.5% as a ratio of corporate profits to GDP. Historically, from a high level, we are there. We've not gone beyond 6%. And primarily so why this growth has happened is because obviously top line was growing, but we have seen a decent margin expansion in corporate India. But of late there has been a bit of a slowdown in terms of earnings. We've seen a bit of GDP numbers also slightly come lower. So I feel that there's an upside risk if growth comes back, and we have levers for growth coming back. Clearly, we are seeing good monetary policy support as well. We have seen 2 rate cuts. We have seen liquidity also improve in the financial services space. Government also provided the budgetary support, especially to the salaried class in the current budget as well. So I think there is policy support which is there for earnings to come back. But I think corporate India needs to spend, because I think they have one of the strongest balance sheets. They're sitting at one of the best times, and I think they need to start spending. They need to start doing the investment phase as required. Some pockets we're seeing that, like especially on the PLI led, where government is incentivizing manufacturing. I think that we're seeing a bit of an uptick, but we need to see the conventional industries also to start spending, and which can lead to another growth cycle as well.
And what could be the fears in market?
So fears, I would say, one, like we spoke earlier, there's a bit of global uncertainty. So that fear, or that can result in a bit of volatility. But apart from that, I think valuation continues to be slightly on the higher side, especially in the mid and small cap space. Because I think there is good domestic interest in that space. So I think that is there. So there is no, I would say, you're not getting things cheap today in the mid and small cap space. So valuation is I wouldn't say a worry, but it's something like if someone is looking to build, I would say, returns over a medium to long term, you need to buy things relatively cheaper to make a good investment journey. But that is not there today, especially in those mid and small cap pocket. Yeah.
Yeah, we have been managing ICICI Prudential Large and Mid Cap Fund and ICICI Prudential Infra Fund. But one theme that has been growing over last few years is factor investing. Can you shed some light on what is it, and what do you think about that?
So, see, broadly, what I understand of factor investing is that generally, if one is you focused on one particular factor which you think should deliver or should help you generate alpha over the broader market, and you focus the fund based on that factor. So there can be different types of factors or constituents of factors. It can be either momentum, it can be either quality, or it can be like I would say value. So basically what it means is that you're trying to the first filter you would adopt while picking stocks would define what factor style you are trying to bias the fund with. So if I want to build, I would say, a growth as a factor if I'm trying to adopt, so I would buy high growing companies or sectors. So that is the first filter I've adopted, and then ultimately it's your bottom up call of which companies you want to buy within the growth basket. So, yeah.
That being said, it sounds very intuitive. You want to buy every stock that is growing, you want to buy every stock which is cheap, and every stock which is quality. That being said, let's look at quality as one of the factors. How would you define quality, and how would you look at putting the filter of what stocks goes into quality?
Correct. I think the simplest definition of quality is that companies which can generate a high ROE or ROIC. I think if a company can do that over a medium to long term, I think it clearly indicates that the company is quality. But what we've seen is that such companies tend to have less debt to equity, tend to have very strong balance sheet. The management is pretty strong. They are transparent, investor friendly, and they are very good capital allocators. Because if you make one capital mistake, also it can deteriorate your ROE for some time. So that is the indicators of a quality company. But the question arises, how has the company generated that high ROE, right? So for that, generally these companies have certain competitive advantages, or at times called moat. I think Warren Buffett has used this term quite frequently. So it is for us as fund managers to identify what is that moat of this company which is resulting in this high ROE. At times it can be different. The sources of moat can be different. It can be low cost, can be a moat. Brand can be a moat. Like if a company is spending on advertisement and trying to build a brand, it can be a moat as well. If a company has a long-term lease, a very long-term lease to do some activity, like at times mining, like if they have a long-term mining lease, which kind of creates like competition is less in that environment, then they can earn high ROEs as well. So that can also be a moat. So ultimately, companies which have moats and then they end up earning ROEs. But for us as fund managers, the responsibility is to identify what that moat is, how durable that moat is it challenged, like are there new players trying to replicate what these companies are doing. So it is for us to do that and try to continuously on a continuous basis keep a view and keep a track on that front. Yeah.
Here, I would like to add that ICICI Prudential is coming up with a new fund offering called ICICI Prudential Quality Fund, an active managed fund looking into invest in quality stocks. Now, what you said, Ihab, somehow makes me feel that quality in this uncertain time is a safer bet. I mean, there's nothing called safe in equity, but still a safer bet. So, looking at recent times, all that is happening in market, is this a prudent time for quality, or how do you know that this is the right time?
Yeah, so rightly said. So what we believe is that when times are uncertain, and like I mentioned earlier, that we are in a moderate earnings growth environment, people tend to appreciate companies which can generate earnings or cash flow on a consistent basis, can grow that on a consistent basis, and the cash flow generation is less volatile. I think that would be appreciated in this top-down macro environment of uncertain times and moderate growth. So rightly said, like, I think we are in a right top-down or a macro environment to look at quality as a framework.
Interesting. So, we've been seeing a lot of quality funds coming on passive side, but there are not many on the active side. So, what is the intention behind launching an active fund versus a mirroring the index or a
Correct.
passive side?
So when we look at the passive or the benchmark, right, to some extent it is concentrated on sectors such as FMCG, IT. It is more concentrated on mega caps because you'll just filter out weightages based on capitalization. What we can do on the active side is that we can identify quality stocks across sectors, reduce the sector concentration, though the sector concentration would be more than any other flexi cap fund because it's a factor fund with higher preference to quality as a style, but it'll be more diversified than a passive strategy. So the advantage of an active quality fund is that in case that particular sector underperforms within the passive, like in case FMCG underperforms, the chances of the passive fund not doing well versus the broader market is high because the sector performance will have a bearing on the end fund performance. But when you're diversified across sectors, I think one sector performance will not have a bearing on the ultimate fund performance. I think that diversification, sectoral diversification, I think that's the advantage for an active quality fund versus what a passive can offer. And like I said, the advantage of it is that for any other active fund is that we can rotate from one sector which we've identified as a sector we should buy and then rotate it into another quality sector which we think can do well going ahead. So this sector rotation plus capitalization, like I mentioned, passive is more inclined towards mega cap and large cap. Though our view today is to be inclined towards that capitalization, but in case if mid and small cap underperform large cap and mega caps, we can tilt the active fund more towards lower capitalization names. And there are quality stocks within mid and small caps as well, because there are segments of the market where the leader itself is a mid cap. So we can buy that leader or the high ROE company within that segment as well. Yeah.
So, how is your philosophy going to be? Is it going to be top down that you identify a sector and thus the company, or is it going to be more bottom up?
So, like I mentioned, the first filter would be high ROE companies. So that filtration will reduce the investment universe, and then it's going to be like sectors which we like, and then within that the bottom up stocks of the sectors which we like. But apart from that, also it will have a blend of bottom up stock picking as well, because the sector itself may not be that big that it will have large cap, mid and small cap. So any bottom up idea which we like, we can end up adding to this strategy. But the first filter is, I think, a kind of non-negotiable. It has to be a high ROE company, and then we can work around blending both, like sector preferences plus bottom up ideas as well.
And as you said, like active, that's the advantage an active
Correct.
fund have, that it need not bind itself to a philosophy. It can be a combination of both top down and bottom up and generate that alpha that
Correct.
passives probably may not over time, because they are very restricted in what they're doing. How has quality done over last couple of years, and what is an ideal horizon that an investor should stay in such a fund?
So over a very long term, quality as a style tends to do better than the broader market because, like I mentioned, they are high ROEs, and if they can deploy that ROE in a highly profitable venture, they can compound earnings very well over a very long period of time. But I think one should look at this space. Like, I think what we like is that we like to look at a space after it has underperformed, and quality as a style has underperformed over the last 3 or 4 years as well. So that's why we've got attracted to this segment of the market today. And I'm a believer that underperformance, what does that represent? That represents less investor interest today in that segment, less crowding in that space, and less investor interest results in reasonable valuation. So there are not too many people chasing the same stock or segment of the market. So valuation is reasonable because it has underperformed. It may not be very cheap because if you're buying good quality companies, they generally don't tend to come very cheap. So I think the valuation is reasonable and you're buying after a period of underperformance. So the entry time is right, is what I feel. And once you've got your entry point right, I feel it is a kind of a very long-term strategy, especially on the active side, because you need not worry that if a sector has done well, am I still holding on to that quality sector? Because what we would tend to do is that we would book profits in the sector which has done well, move into another sector which we think represents quality, may not be doing well temporarily today, but is expected to do well. So that shift is something which we would be doing on the active side. So if you get your entry point right, it is a long-term strategy.
True, and actually this is the most common fallacy, and we were just talking about it, rear view investing, that what has performed will continue to perform, is a fallacy that most investors fall for. So actually looking at a sector or a factor which has underperformed might just be the right thing to do at the right time of today.
Correct.
Now that being said, talking about the ICICI Prudential Quality Fund that is just coming, what are 3 or 5 USPs of the fund that you think investors should know before investing in the fund?
So I think the unique USPs of the fund, like I mentioned, is I think the timing is right, predominantly because of the uncertainty and the moderate earnings growth and the underperformance. I think this is a strong, investor pitch from a perspective, because I think it fits right to be invested in this particular theme. I feel once you've got your timing right, it is a strategy which one can buy and hold, because ultimately you're buying India's, or at least companies within the sectors which they represent, because they are high ROE companies and they're run by good management also. So the other aspect of growth or whether we're buying it reasonable is something which we will take care of. But if you ended up buying a good company, generally your return journey should also be good. So I think that is how it will look, and it is going to be a less. What we feel is that the risk-adjusted return for this strategy is to other styles of investing or the broader market, because like I mentioned, the earning profile is less cyclical, as a result of which the stock price return or journey is also less cyclical. So on a risk-adjusted basis, so if someone who is seeking less volatility in his equity portfolio, I think this strategy fits it, because on a risk-adjusted basis, this comes out superior to other styles and broader market.
And that's very true. And I think risk has been one of the parameters that has seen to play in the market. I mean, last 3-4 months, we are consistently seeing that SIP cancellations are more than SIP registrations. People are wary because volatility is not, lot of new investors have come since COVID and have not seen volatility. And there is that sense of uncertainty. At such a time, investing into something which is, as you said, less cyclical, probably a better quality and a more long-term bet is probably just the right time. Great, yeah. I think this was a very insightful session. We got a lot of insights on factor investing, what's your view on market, and the upcoming ICICI Prudential Quality Fund. Thank you for taking
Thank you
time
so
out
much.
of your busy
Thank you for
schedule.
having me.
Thank you guys once again. As I mentioned, ICICI Prudential is coming up with a new fund offering called ICICI Prudential Quality Fund, which starts for subscription on 6th of May. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.